Hi, my name is Steve Walker from Promise Money, and this video is aimed specifically at business owners who are looking to purchase business premises or remortgage business premises. It's not for investors who want to own commercial property to rent it out, unless they're renting it to their own business. So yeah, if you're a property investor, this might not apply to you. There was another video, go and watch that one. So let's talk about what you're going to get from this video very quickly. We're going to talk about the critical factors which affect the amount you can borrow, the rate of interest you're going to get, the loan to value that you might be able to borrow to, what sort of deposit you're likely to need, how we can boost the profits and how different lenders look at your accounts in order to get the maximum amount you need. Different property types, some lenders like, some don't like others. Your profile, what you're about as a person, your asset background, your credit history, both your business credit history, your banking credit history and your personal credit history. And we'll talk a little bit about owning the property, maybe in one company and renting it to your trading company, because a lot of people like to do that. And we'll talk about buying businesses where there's now to bricks and mortar and goodwill. So we're going to cover all of that. So let's just start by setting out what the market looks like and the different lenders in the market. There are essentially 4 tiers of lenders, and the tier 1s are the names you're going to know, the more mainstream lenders. They're fussier. You need to have more income. They might not lend you quite as much on the loan to value, but you might get a lower rate. It's not always, because some of the tier 2 lenders can outperform them. But if you want to get into that sector, then we've got to get everything looking absolutely bang on with loads and loads of income. And I'll come on to that in a minute, because they really do stress test the heck out of you, out of the affordability. Your tier 2 lenders, they're also banks as well. You know, they're well organized challenger banks. But they tend to look at things which are a little bit more quirky. They tend to be easier on the affordability calculations. They offer interest only, which the mainstream lenders don't like. And then you've got the tier 3 lenders, where they can be a little bit more projection led. They'll look at properties that others won't. They'll look at businesses that others won't. And then you've got tier 4 lenders, which there aren't too many of them around, thankfully, but I don't tend to get involved with tier 4 lenders if I can help it, because they really are a last resort, and that's because they're expensive and their criterion terms are not attractive. So why go there if you don't need to? And also, they're not always as honest as they should be, especially if you go to them direct about the downside of their products, which you don't find out about until you've got it. So if we ever do a loan with a tier 4 lender, then we're going to tell you exactly what you're getting into, because you need to know. Let's talk about loan amounts now. If you are looking for a small loan amount, simply put, there are less lenders, which means you might end up paying a higher rate. So most commercial lenders, their sweet spot is £250,000 upwards into the millions. They don't want to get involved in the smaller loans. If you are looking for a loan of 150,000, yeah, there's a few there. But if you go below 150,000, there's very, very much fewer lenders, and your choice is really, really limited. On the plus side, if we can get you into a high street lender, some of the high street lenders still go down to 50, 70, 100,000 pounds. So you know, there are some good options there, but to fit a high street lender, you've got to have a really great set of accounts, a really great business profile, etc., etc. So loan amount can make a massive difference to the loans, the lenders that are available to you. The loan to value range, really you need to be working on a maximum of 75% loan to value. So you need a 25% deposit. But be aware that a lot of, again, mainstream lenders, depending on the risk grade of your business type, they might only lend you 65% or 70% rather than 75%. You can get away with a 25% deposit. Of course, you're going to need extra cash for your stamp duty if you're buying, for legal fees, valuations and such like. So we do an awful lot at 75% loan to value for owner occupiers, but there are some lenders that won't go there. So again, it is a factor. If you have a higher deposit, it might give you more choice. Speaking of deposits, bear in mind that if that deposit is coming from abroad or even from the UK, lenders want to see that deposit. They want to see it in your bank account, and they want to see how it got there. So especially for those who are bringing money from abroad, maybe gifts from parents abroad and things like that, they're going to want to see the trail of how that money got into your account, bouncing between different bank accounts. And this is a money laundering requirement. It's not something, they're not being awkward, it's something they have to do, otherwise they get fined. So that's deposits, important. Now, also bear in mind that most commercial lenders, when we're talking about loan to value, will lend against the vacant possession value of the property. So if you're buying an empty property and you're going to move your business into it, the valuation and the purchase price are going to be based on vacant possession. But let's imagine, I've got one at the moment actually, it's a guy who's buying a trading business, and the purchase price is 1.2 million, great. But the trading business has some value in that, and the building has some value. And we don't know the difference between the two. We don't know what the building's worth, we don't know what the trading business is worth, and you don't know that until you get it professionally valued. So just bear in mind that a lot of lenders will only lend on bricks and mortar. So if you're buying a trading business where there's an element of goodwill in that, try and establish the value of the business. Speak to the agents, speak to local property experts, because some lenders will only support a loan against the bricks and mortar. If we know there's goodwill there are lenders which will lend against both, and some will do a loan over the whole lot, and some will say, well, we'll give you a loan for the bricks and mortar and we'll give you a separate loan for the goodwill. But it's important that we understand that. So goodwill is important. Now, OpCo, PropCo. This refers to a situation where there is an operating company, OpCo, and that's your trading business, and there is a property company, PropCo, and that is owned separately from the trading company. And a lot of business owners say, right, okay, I've got my business trading over here. I'm going to buy a building and I'm going to buy it in a separate limited company. I'm going to buy it personally with my partner, and I'm going to rent it to my business. And because I'm renting it to my business, it seems right that as long as that rent stacks up for the affordability of the loan, then it all ought to be fine. Well, that's not the case. Firstly, because it's a rented property, if you try and play that game, the lender's going to say, well, if it's investment, then it's going to be a high rate of interest anyway. But they will make the connection between the operating company and the property company having essentially the same shareholders or majority shareholders. They'll say, well, you could make the rent whatever you like. And because it's your business who's renting it, we need to see that your business can afford to pay the rent, and therefore the rent can afford to pay the loan. So they will still look at your accounts, and that's OpCo, PropCo. I won't say any more on that. It's bloody confusing, but if that's the scenario you're thinking of, tell us about it. We can work through it. Business type. If you're buying a casino or a social club or a church, most lenders aren't in the game for that. We do have lenders that will do those sorts of things, but most aren't. And there are certain sectors that lenders don't like to go into. There's one lender only recently has come back into offices. They used to cap their loans at 65%. I think that's probably an overhang from COVID. So if it's offices, we'll only go to 65%. They've now gone to 75%. But some lenders, for example, if it's let's say it's an ex-petrol station, contaminated land, big concerns. We'd rather not, thanks very much. Some lenders, even if you're in motor trade, will say no, we're not keen on that. So whilst we'll go to 75% with every other business, on motor traders, no, we'll only do 65 or something along those lines. So the type of business, we need to understand that at early days, and the type of property can have an impact. Another thing to think about if you're buying a property is, what's the proposed use of the building and what is the current planning consent? And I can give you a good example of that, which was motor trade. So we had a guy who had a successful motor trade business on rented lot, and he saw a building. He thought, that's great, that's going to make a fantastic showroom. And when we got into the nitty gritty, the building he was buying only had planning for storage. It did not have planning to be used for sales or as a showroom, which meant that if he bought it, he wouldn't be able to move his business into it. And the lender's going to say, well, okay, if you can't move your business into it, that means you've got to pay rent at the same time until you get that altered. So that then puts a stress on the affordability, because you've got to pay rent over here and you've got to pay the new loan. So understanding the planning, important that you know the planning, what the planning consent is on the building you're going into, and it's going to meet your needs going forward. Doesn't mean it's impossible, but again, it's something we need to have a conversation about at an early stage so we can look to build that into the plan. I'll also mention at this point energy performance. Energy performance certificates, some lenders are giving discounts on that, quite significant discounts, like 0.25%, which is significant on a lot of money. So if your EPCs on the building that you are buying or remortgaging are C or above, some lenders will give you a better discount. If you've got a building you're thinking of remortgaging and you can just do a little bit of titivating with it to get the EPC to C, then do that first before you remortgage, because you might get a better deal. Probably better still speak to us first so we can tell you whether you qualify for that particular lender. And then a little bit of information that the lenders will want to know is about you as a business owner. What's your asset background? What's your experience background? This isn't generally too much of a problem, because unlike with landlords, where they like to see landlords have got experience, if you've no experience in commercial property, but you've got experience in running your business and then you're going to be moving to commercial property, they're generally okay with that. The area that lenders are going to dig into is both in regards to you and to your business is credit history. And I don't just mean your credit score. I mean the credit history for the business. They'll run a search on the limited company just to get a report back on the business. Other things that they will look at is your bank statements. So, things to look out for in your bank statements. Are you using an unauthorized overdraft? Stop doing it, because if you're going into an unauthorized overdraft, that's showing lenders you've got stress. You've got a problem with your cash flow. They're not going to want to lend you more money. If it's an authorized overdraft, well, that's not so bad, because all you're doing is you're managing the facility sensibly. But if it's unauthorized, not a good sign. If you've got bounced direct debits on your bank statements, not a good sign. They won't like that at all. If there are payments going out on a regular basis to HMRC, what's all that about? If it's a one-off, quarterly or for your VAT or whatever, that's fine. But if you're on direct debit with HMRC, that generally means you've got an arrangement to pay. That often means you've either not paid your tax on time or something similar. Lenders don't like that. So if you're looking down the road at wanting to buy a property in 6 months' time, I'd be getting all of that cleaned up now, so that when we provide 6 months bank statements to the lender, none of that shows. Okay, so let's now just talk about serviceability now. And this is really the big one. This is the complicated one, where we have to evidence to the lender that your business can afford the loan. Your tier 1 lenders often take a 2 or 3 year average of your profits. And that means that if you've got a business which had a great year last year, I've got a guy who his business has only been going 2 years, and he did £50,000 profit in his first year and 120 in his second year. But the lenders are saying, tier 1 lenders, well, we'll take an average. And that doesn't get him to the amount that he wants to borrow. And your tier 1 lenders apply much more aggressive affordability calculations, and I'll explain those to you in a minute. Tier 2 lenders, they're a little bit easier on the affordability. In fact, quite a lot easier on the affordability, and they will offer interest only repayments, whereas your tier 1 lenders won't. And some of them will calculate the repayments on an interest only basis, which means the loan becomes very much affordable. I'll give you an example of that in a minute. Your tier 3 lenders, when it comes to serviceability, may even look a little bit on projections. I've got a client at the moment whose her accounts are rubbish because she's invested so much into her business, and now she's got the opportunity to buy the business that she trades from. She desperately wants the building. She desperately wants to buy that building, and her accounts are not good. So we've had to go to a lender where they'll say, well, yeah, we will work on projections and we'll look at the overall trend behind the scenes to make it fit. Your tier 1 lenders, it's no, I'm sorry, it just doesn't fit. And then your tier 4 lenders, well, we want to avoid those if we possibly can, because they are expensive, they have high costs for getting out of the loan, and they don't always tell you the truth about what you're getting into. So a tier 4 lender, if that's the only option, then we'll give you all the bad news before you possibly go anywhere near it, so you know what you're getting into. So let's talk about serviceability now. You've got a set of accounts, and whether it's OpCo, PropCo, whatever it is, the lender's going to want to see the accounts for your business. They're going to want to see 2 years accounts for your business to get into your tier 2 and tier 1 lenders. If you've only been trading 1 year or just a little bit over 1 year, then we might be into tier 3. So let's have a good look at 2 years or ideally 3 years accounts, and it needs to be the full set of accounts with a balance sheet and the trading profit and loss. And what my job is to do is, as well as presenting this whole application in the most positive way, is to work out the affordability that the lenders are going to use so that we can make sure we can persuade them that it's affordable. So there are things that we can add back to your profit. So think about these. If you've got a high amount of depreciation, we can add that back. Obviously, corporation tax, we can add that back. And this is all to arrive at your EBITDA, which is your earnings before interest, tax, depreciation and amortization. But there are other things that we can add back. If you're paying rent in a building at the moment and you're going to move from that building to a new building, then you won't have 2 sets of rent going forward. So we can add that rent back and say to the lender, that won't exist in the future. We can add that back. You might have incurred massive expenses refurbishing a building, and you might have taken all of the hit in 1 year just to get rid of it, to keep your tax down. That's not going to happen next year. So we'd justify to the lender we can add that back. They're going to say to you, well, evidence to us that you've spent that money on those refurbishments, so invoices, etc., etc. But then we can add that back. And sometimes that factor, adding it back to your profits, can be the difference between getting the loan from lender A, B, C, and D versus lender E, F, G. You know, you can get into a different tier of lending because we've added that back, and all of a sudden the affordability fits. Other things that you might be able to add back is if you're consolidating and paying off debt as part of a remortgage, and those debts won't occur going forward, then we'd add those back. So there's lots of things that we can play with. Another factor is, and if you've got a nice successful business where you're taking dividends every year, this could affect you, because let's say you've got a business and it's making £100,000 profit every year. After you've paid yourself £12,000 salary, because you don't want to take your income as salary, you take the rest of dividends, and you're taking out that £100,000 in dividends every year. That means your balance sheet stays the same, and it means you've got no other disposable income. It means you, with those dividends taken, you can't afford any additional borrowing potentially. So in that scenario, we have to justify to the lender that you've taken that dividend because you're entitled to, but you don't need to. So let's take a scenario where your living expenses are £30,000 a year or £32,000 a year, makes it easier. So we've got to demonstrate to the lender that you can take £32,000 a year out of the business. Well, you're taking £12,000 as salary, and you've taken £100,000 of dividends. So we would say to the lender, well, look, you only need to take £20,000 as dividends to cover your personal expenditure. So we'll add that other £80,000 of dividends back into profit. So that's another area that we can play with. It'd probably be helpful if I just give you an example of the difference this can make. So your tier 1 lenders, they will calculate the affordability based on capital and interest, and they will want to build in a big buffer. So if your monthly loan repayments are £1,000 a month, they'll build in a buffer, which could be, well, we want to see at least £1,600 a month or even £1,750 a month available to meet our repayments, because that's the buffer that we want. Whereas your specialist lenders might only need 125% instead of 175%. And because the tier 1 lenders are calculating on a capital and interest basis, you're paying the loan off over the term, so you're paying an element of the capital, which means your repayments are higher, and they'll factor that into the affordability. Tier 2 lenders potentially can calculate it on an interest-only basis, which means that they've got a lower debt service coverage at 125%, and the repayments are lower. I'll give you an example. So let's take an example where we've got an EBITDA, and we've worked through the accounts, and we've worked out the amount that the lender's going to use to support the loan is £100,000. And we go to a tier 1 lender, and they say, interest rate 7%, 15-year term, capital and interest, and we'll apply our debt service coverage of 175%. That means on that £100,000, we will lend you £525,000. And that might be enough. Happy days. We then go to a tier 2 lender and they say, right, well, we'll lend it at the same rate, and based on that £100,000 profit or EBITDA, at the same rate of interest, we'll calculate the affordability on an interest-only basis. We'll apply a lower debt service coverage at only 125%, and that means you can borrow from us 1.14 million, double the amount, and that's the difference it makes. So in some cases, for applicants where we can't get it to fit with a tier 1 lender, we'll drop to a tier 2 lender, we'll go interest only and see what we can find from lenders there where we can borrow far more. So that's the importance of that. So what have we learnt? It's complicated. There are lots of factors that go into this. I would say what you need to do is establish the property that you're looking to buy, establish the deposit, look at your bank statements, make sure that you've got 6 months bank statements and you haven't got too many glitches in that, and look at your accounts, and if there are things in there that you think we can add back. Another one's just sprung to mind. I had a client who was paying a consultancy for lead generation. It didn't work out, but it cost him £20,000 in the last year for consultancy for lead generation. He's not doing that going forward. Add it back. Look at the add backs, look at your accounts, get your accounts up to date. If your accounts aren't very current, and by that I mean your year end was 7 or 8 months ago and you give me a set of accounts which is 7 or 8 months old, the lenders are likely to say, yeah, okay, we can get a feel where this is going, but we want to see the management accounts for the last 7 months, or at least 5, to get us recent, so we can see that whatever your business performance was like in the preceding year is continuing this year. So management accounts are also important, and let us look at the numbers at an early stage. Once we understand what you're trying to do, how you're going to service it, the type of property, and all about your business, then we can very quickly say, right, well, these lenders are in and these are out, and here's the options. So I think that's about it. There's a lot there. So finally, what I would just say is, if you want more information, go to promisemoney.co.uk. I don't think you'll find more information on the pages than I've given you on this video, but it might be easier to digest. Watch this video again and just jot down the things that I've said that might be important to you. And please do like our videos, subscribe to the channel and share them, because there's lots of other stuff coming out all the time. So we like to keep you updated on the latest information. Hope that was useful. And if you want to get in touch, like I say, go to the website, Promise Money, and get hold of us and we can have a chat about what your plans are. Thanks a lot for watching. Talk to you soon. Bye-bye.